Hey everybody, this is Jose. We are about to get started. As always, I would appreciate a quick hello on the chat box that would tell me you hear the sound. So sound is good to get started. So please sound check if that's okay. Quick message on the chat box. Quick hello to everybody in the trading rooms. That way we can start on time, everybody. I will be turning on my video stream. This time I didn't forget, like the other time. Remembered halfway into the session. So I can say hello from the bottom right corner as always. Again, just a few seconds to go. Hello guys, thank you for those confirmations. My pleasure to be today here ready to talk about options. And we are just hitting the starting time for the session. So my friends, it is my pleasure to say we are live. Hi Mark, Ahmed, Christian, everybody. Good to see you, my friends. We are live April 7, 2021, ready to trade options. Options give us options, isn't it? So again, we're going to be exploring the markets, looking for those opportunities and enjoy the magic of options trading, which allow us to really adapt to different type of scenarios. And, we've been having a lot of fun in the past weeks, rolling positions, adapting positions. We need to comment on certain things that happen. Some of you are in the Facebook trade, so we need to talk about that one, of course, the other ones too, and then get into the markets and look for more trades. Okay, so we'll do all of that and more. Before we start, as always, I would like to highlight the disclaimer on the upper left side of your screen. Please read it carefully. This is important information. Do not skip it. Just read it carefully. Every word is important, so please take it seriously. I'm counting on you to do that. Cool. So the plan for today, as always, we just said hello. I just want to remind you all that we are simulcasting. There are a few consequences of simulcasting. Could be a little bit of video lag, depending if you're on Facebook or YouTube or inside our webpage, which is tradewithufos.com/live, where we have our private room. So those are some of the consequences. Other consequences as well is the fact that we are simulcasting in public and private environments at the same time. Also implies a series of things, such as we are using the public environment, such as YouTube, for example, kind of like trying to support in our community what I would define in a simplistic way as the part-time traders. Okay, the traders that you obviously look at trading seriously, but you have limited time, or you don't want to put much time into it, and you are just from time to time connecting with us. And then we do on our private rooms, which implies a monthly subscription fee and so on. You can see all of this on our website. We are then doing the full duration sessions, so you got more of the same. The content in the public spaces such as YouTube and the private room is the same, but it's just that the duration of the sessions in the private room is longer. So for that second group of traders, the ones that you are like me, that you never got enough, you always want more, you love trading, you are passionate about it and so on. So probably you prefer to be in the private room so you can enjoy that. Okay. I normally don't talk much about memberships and stuff because you can see that on the website. Okay. But just know that the yearly membership for the coaching programs implies that you also get granted free access to one of our courses, one of the courses of your choice. You pick the course you want, but you get access to one course for free as well. So it's a great opportunity to learn trading, improve your skills, learn to use the apps, and then join us in the coaching and all together. Again, of course, then you need to apply yourself and put some time and effort, obviously, but all together, should make a difference in your trading. Okay, so again, this is what we are doing. The session, we're gonna look at the market, then we'll review the trades that we have, and then we'll jump into looking for other trading opportunities. Very good. So let's get started. And here it's TradeStation. And as I just said, we're going to start with analyzing what the market is doing. And the market, as we were expecting last week, and again, I'm not saying this like I'm bragging about it, because this is not about market analysis. This is about trading. It's all about playing the odds and managing the risk at the same time. It's not about you said something was going to happen. Next it happens, and next thing you know, you are that proud. Okay, well, that's not how we make money. Okay, we make money sometimes by being wrong, but keeping the losses small, and again, putting emotions and pride on the side. We are just analyzing how do I call it, facts. We are analyzing specific objective data, and this is what basically tells us if it's time to buy or sell, or what and when and how, right? So what we were doing last week, we were looking at the climate with the S&P, and in the middle of last week, we were somewhere in here, and we were like, okay, the climate is confirmed, is blue, market should go higher. Statistics suggest that when the market goes up, it's going to be 8 to 9 candles. Let's call it 9. And last week, we were talking about, candle 2, candle 4, depending on the day of the week. So again, the expectation was the market to continue going higher, especially because many of those green UFOs showed up last week. And therefore, not only you have the statistics on your side, but you also have the order flow suggesting that there would be more buying than selling, and therefore helping the market to continue going higher. Okay, so that's what's happening. Okay, but while it's nice to see that that's happening, and we kind of anticipated that to happen, we need to start taking it easy now, because today it's candle 7 out of what statistics suggest an up climate of up to 9 candles. How are you, Joanne? Good to see you. And basically, another day, another 2 days, another 3 days of having the market go up would not be surprising. Actually, that's what statistics suggest. But at the same time, soon, okay, to start seeing the market to turn around and maybe have let's call it a decent retracement, okay, which maybe just, like statistics suggest, 3 candles on the way down, like it happened here, or here it was only 2, here it was a bit more than 3, okay. Just seeing a little bit of, a correction, a retracement, market breathing a little bit to start pushing again. So that certainly could be something to expect. So if you are in a position, you got in and the market pushed very hard, and that's fantastic. But at the same time, make sure that does not trigger any sort of human emotions in the form of, overconfidence or things like that, because then you will lose the objectivity of your planning and your execution. And make sure that your targets are in place. If you are trailing stops, you are trailing stops. So whatever you are doing, make sure you are disciplined in your approach, no matter how exciting it is to see the market again one more time make all times high, with this huge running gap, and amazing push to the upside. Okay, so all of this is definitely beautiful to see, but at the same time, we need to take it easy and be professional. Okay, so now when it comes to the VIX, well, I guess you are kind of expecting it, isn't it? The market has been going higher, so what happens to the VIX? Well, it's now hitting 17, right? I was kind of complaining. I mean, that's not the right word to use in trading, because the market doesn't owe anything to us. It's like going to fish, right? And you cannot complain about the sea if the weather was better or worse, but at the same time, it's a human thing to do or to say. So I was kind of complaining last week that, volatility was going below, those lows, right? And we were dropping pretty low to levels that we have not seen for a long, long time, okay? A snip board on SPY. And so the fact that the VIX was going down, was making our life a little bit difficult if you were looking for non-directional trades such as iron condors. And if you were in trades like we are in trades, like the trade with Philip Morris or AFL, where we are in those calendars that benefit so nicely when volatility rises. Well, seeing the volatility going down, of course, it's not really what you want to see, isn't it? But again, that's what's happening. Okay. The good news, though, is that when that happens, it's very, very good for when we find opportunities to be directional, and we just buy spreads or buy a call or buy a put or something like that. And that makes those trades to be less risk, because the price of the option is less, so you pay less. So because you pay less, you spend less, and because you spend less, you have less to lose. So less risk, right? So everything got pros and cons in life. And our job, while we may have preferences because we are human, but our job is really to push away those preferences and just to adapt to what we have in front of us objectively, instead of be like, no, I still want to do that because, that's whatever, right? So again, it will not be a reasonable approach to trading, because again, the market is bigger than us and the market is the boss, okay? Cool. So now that we understand a bit better the market environment, okay, I'm going to start reviewing some of the trades. We'll start with Facebook, okay? And with the Facebook trade, okay, you can see that not only we ended up breaking the range, which statistics suggested that was very likely going to happen, but on top of that, okay, now we are outside the blue zone that we drew last time. The blue zone was going to be the zone where profits could be found, okay, where profits could be found if the market was to break the original iron condor range, but then was to stay somewhere in that light blue area. Well, not only the market, Facebook in this case is not staying in the light blue area. On top of that, you can see how there is a green UFO that forming the light blue area, meaning that if price was to come back to the light blue area, very likely it's going to keep going, okay? Unless, you know, the S&P really retraces hard, and of course, stocks are fragile, they depend on the market, and it may go back down. So definitely this trade is really not looking good, okay? It's really not looking good. We were talking about it since the last week, since the prior week, actually. That's why we kept doing those rolls, actually, I was not calling it rolls, I was calling it tweaks, isn't it? So we kept tweaking it to the point where the last action that was taken, the last instruction I gave you was to convert this trade into an iron butterfly if we were to cross the red line, which was a couple of days ago. So I left the order in the system, hopefully you did too, and here is a copy paste of the order report I got from the Thinkorswim platform when the order was executed. So what this order did, okay, was to close the 265 to 60 puts and open the 305 300 puts to combine with the calls of the iron condor we had before to produce an iron butterfly. So the setup that we had before was long the, let me say that correctly, yes, long the 310 call, short the 305 call, and then we were short the 265 put and long the 260 put. That was the last iron condor that we had in place. So what did we do with this trade? We killed the 2 puts below, okay, and in exchange we ended up selling the 305 put, and we bought a protective put below at the 300 area, okay? So these 4 units together, okay, the 2 on the left plus the 2 on the right, those 4 units together is not an iron condor any longer, it's now an iron butterfly, okay? And why did we say we would do that? Well, I did go over lots of details the other day, but now that we have done it, let's plug all the values one more time in the Option Station Pro, so we can now evaluate what is it that we got in our hands, and you will see how the original risk of this iron condor that was $500 is going to be reduced in a massive way, and of course now our profit zone is only the light blue area, but again it's kind of like giving the trade a second chance, okay, to make us happy, where the trade was going to end up, you know, badly, so we're going to end up with potentially either a very small loss or a very limited risk, or maybe if we get lucky, and notice I use the word lucky, which I don't like to use, but in this case that's what it is, because you know the market is going up and we got green UFOs and everything, so if we end up in the blue area, we should feel lucky, okay, because you know this is a defensive action. What we're doing, this is damage control mode, this is not planning any trade, this is trying to minimize the problem that a losing trade is going to provide in our account. Very nice. So, and by the way, I'd love to hear your comments on the chat box. If you guys are in the Facebook trade and you were able to get filled and converted the iron condor into an iron butterfly and all of this, I would love to hear your comments. So look at what I'm going to do here, guys. I'm just going to click to analyze and duplicate this trade. So I'm going to end up with 2 iron condors here. The one on the top, I'm going to uncheck it. So it's unchecked. This is the one we have now. Okay, and the one below, what I'm going to do with the one below is I'm just going to change the values, change the strikes. I'm going to have to change also iron condor and make it custom because it's not an iron condor anymore. So I'm going to change the strikes to be 305 300, which is what I said before. Okay, 305 300, which is what I said before, and that way we will understand much better what we have in our hands. Okay, now 1 second, okay, because I did change the strikes, but now I need to update the price. So when I did this conversion from iron condor to iron butterfly, you can see that the order report shows that this order was filled at 234. Okay, well done, Maka. Very well done. So it shows that we converted at 234. Okay, so that means that we collected net $2.34 on top of the 116 we already had. Okay, so we already had 116. That was the original condor. You can see on the top, isn't it? 116 right here. Okay, that's the original condor. So now in the bottom part, we added, I just said 234. Very good. So basically, the net credit to be collected will be 234 plus 116. Okay, so that will be a total credit collected of 3.5. Okay, which 3.5, if I add it here, okay, manually, okay, if I add it here, that's gonna give me now the risk profile, okay, of the trade that we have in the account at this moment in time. Okay, so let me compact all of this and let me scroll it down so we can have a great visual view of the profile, of the risk profile graph. Okay, and again, I'm just gonna uncheck everything, so we got nothing. I'm gonna start with the iron condor, which is what we had prior to the conversion, okay, prior to switching to damage control mode. And that was a condor where if we were to be wrong, we would lose 384. Okay, and we were wrong, isn't it? We were wrong. I mean, right now, if we were to be in this trade now, you would be underwater by $202, okay, which is right here. And as time passes, okay, it could go all the way down to $384. Okay, so again, we are totally wrong on this iron condor. We are far away above the statistical range we were playing. If you did nothing, you would be now experimenting $202 of pain, going to very likely become 384 on the expiration date on April 16. So that's why we did something about it, because we don't want to suffer all that pain. So what did we do? Well, what we did is to convert into an iron butterfly, which I have it here below. Okay, so now I check mark the bottom one. And what did that do to the problem? Well, first, the real-time P&L is not minus 200, it's minus 88. Okay, so that's good. Okay, now, of course, the profit range now goes from more or less here, which is 301, to more or less here, which is 3085. So again, let me see if that's more or less accurate here on this box. So 3085, and let's call it 3015. Okay, so this is a bit more accurate. It's just a little bit tinier as a blue box. Okay, it's more or less like that. And again, for us to end up in profit, price has to stay, it has to come back to that blue area. If price is above or below the blue area, then it's going to be a loss. Okay, but what's the beauty? Okay, not sure if beauty is the right word, because this is that would be a losing trade if that's the case. But again, I want to use the word beauty, because what's the worst case scenario? The worst case scenario is not to lose 384. The worst case scenario now is to lose 150 if you were to be wrong. So again, not ideal, or maybe yes, it's ideal, because when you trade, let's say, futures or stocks or forex or cryptocurrencies, if you buy at a price and you plan to have a stop at a different price, whatever you're going to lose is whatever you're going to lose. And if you're wrong, you're going to lose that, and there is no way you can limit that or make it less. The beauty here is that we started with a risk close to $500, and now, after being proven wrong, the worst case scenario would be 150 negative. If, again, I'm going to use the word lucky, not that I like too much to use that word, but really at this moment in time we depend on that, okay? Because we are not entering a new trade with statistics on our side. You know, the trade failed, okay? So this is something we need to understand. So if we were to be lucky and the price of Facebook was to come back somewhere in the middle of the range, then we're going to go back to profit, okay? And the later that happens, the more the profit is going to be. And the best case scenario, okay, which that's going to be very rare, but the best case scenario would be to profit up to $343. So not only we limited the risk, we actually may end up with some profit up to $300 over. Now, realistically, the range from 301 to 308, it's pretty narrow. So again, you really need to be lucky to end up in a profit. Okay, it's not. This is a defensive type of action. This is damage control mode. This is not like now you do magic with your trade and suddenly you have a high chance of profitability. It's not the case. This is damage control, And as you can see, we are accomplishing that goal with a little side benefit, which is if we didn't do anything, the most the Iron Condor would have made would be $116. But by doing the Iron Butterfly, while it's unlikely to end up, making $340 over dollars, well, now the most you can make is actually more than before, and the most you can lose is less than before, in exchange for a narrower range where profitability would take place. Okay, so definitely a good trade-off, certainly a smart action to be taken, and glad to hear that you guys took action, no emotions, and mechanically you executed this particular trade. And we'll keep observing it, okay, because this trade will expire on April 16. So definitely tomorrow, next week, we'll keep talking about it, because maybe we have to do something else, okay? And if that's the case, I will certainly lead you into potential future actions, okay? Even though, to be honest, it really looking like, this trade, it's certainly not in our favor, especially when the green UFO shows up here. So again, odds suggest that if price comes here, then it's going to bounce back up, and again, ending up in the blue range. It's at this point very unlikely, okay? But again, as traders, always managing our risk, and therefore, Facebook is under control, while it didn't meet what we were expecting it to happen at all. But I mean, to be honest, we were wrong on this trade from the very beginning. We took the trade at this moment in time. We were expecting Facebook to range, and look at what happened since that moment in time. So it was one of those trades that went against us all the way. Okay, so yeah. The report from TOS, I got it in my email. Okay, and I just copied and pasted on the Word document. Okay, so you can come in here in the setup. Okay, application settings. Okay, and where is it? Under notifications. Okay, under notifications, you can go ahead and set your emails and all of this, and you can basically have TOS to send you automatic emails when you get filled. Okay, so you can keep track of that easily. I personally, maybe it's a bit old school, but apart from having the reports that TOS or brokers in general will provide, I do like to receive those those email reports. Okay, Christian, why not add going long? Well, the reason why not is because now, instead of working with a damage mode approach, you would be working with a trying to repair and fix a problem, which may add too many emotions, if you wish, especially the emotion of hope. And if you think about it from a statistical point of view, it would not make sense to do that, because look at what the climate is telling you. Okay, 7 out of 6. Well, Facebook, it's now entering a territory where, based on probability, is more likely that it's gonna stop going higher and go back down than keep going higher. So if you were to go long now to try to offset the problem, you're making a collection of mistakes in cascade. If that's okay for me to say that, well, your question is very good, and your thinking makes a lot of sense. You would be ignoring the real market condition, and somehow probably it's the unconscious mind. We are human, isn't it? So it's the unconscious mind hitting us with that emotion called hope, trying to, okay, what about we do now and we're gonna fix it, right? So again, it's okay to lose, guys. Okay, that's something that we need to understand. It's okay to lose, and here we did a very good job converting a loss that could have been 500 to a 150 worst case. We'll see how the trade ends up. We may end up on a profit. We'll see. But worst case is gonna be 150, which again, if you started with willing to accept 500 and you end up with 150. To be honest, there is no need to try to fight it. It's no need to try to fix it or fight it or fight against the market or get emotional, because it's just a tiny loss, much lesser than what you were planning at the beginning. Okay, so good point, but hopefully my point I also made sense, Christian, and everyone. Let's keep going. So we're gonna review now Philip Morris. Okay, and Philip Morris. So let me load it as well here on AutoUFOs Pro. We'll be looking at TOS as well. So again, when you look at Philip Morris, okay, what happens when you look at the PNL here, and it's gonna show negative 223, right? Well, yeah, This is the real-time P&L now. But remember, we've done a collection of roles that created more premium for this trade. And therefore, the net P&L for this trade now, if you were to sum and add up everything we've done, is actually $21.50. So this trade is currently in profit. Okay, it's currently in profit. And the question is, what do we do with it? Okay, so do we close it? Do we keep it? Do we what? Right? Again, remember, this trade is a trade where Vega is a great ally of ours. It's a horizontal spread. We are willing to see volatility to increase. Okay, we are using the expiration date that is lining up with earnings, expecting to see volatility to increase as the earning date approaches. So there is not a clear reason to get out. Okay, so we're gonna have to look at implied volatility. We're gonna have to look at what if we roll, what's the benefit. So we're gonna have to look at multiple aspects of this trade to conclude, okay, let's close it and go for another one, or let's keep rolling with it. Okay, so let's take a look. I'm gonna start looking at rolling possibilities. Okay, so the current trade is using the 87 puts, the one we sold that expires in April 9. We traded it when its price was 37 cents. The current price is 10.5. So it looks like, fairly low premium. Okay, so I would like to look at those Greeks. Okay, looking at April. Here we go. Looking at April 9, 87 put. Okay, which is right here. It has a midpoint of 44, extrinsic value. Okay, wait a minute. Is that, am I saying the right thing? Is it 87? Yes, 87. Oh, okay. I'm like, that's not possible. It's April 9. Here we go. Now I got it. So 87 put got a midpoint of 9 cents. Extrinsic value is 9 cents and theta is 7 cents. So we are dealing with distorted Greeks one more time, isn't it? Because if you think about, we have 2 days and a half to expiration. You take 2 days and a half times theta, which is 7, and that would be, 15, 16, 17 cents, which is definitely more than 9. So again, it's time to roll, and therefore the one we're gonna sell against is the same 87 option, but this time the one that expires on April 16. Okay, so let's go ahead and simulate what would happen if we were to do that. Okay, let's simulate and see what would happen if we were to do that. So I'm going to duplicate this position, so that way I can be very visual. Again, if we do nothing, this trade will make a maximum of, let's call it $80, with a maximum risk of 87, and the range would be anywhere between, let's call it 85 to, let's say, 89. Okay, so 85 to 89, and more or less 1 to 1. Okay, now what if we were to take this 87 put that expires in April, and we were to roll it to the same 87 put that expires in April 16? Okay, well, that would allow us, if we do it now, to collect 33 cents. So what's the impact of adding another 33 cents to this trade? Well, the impact would be, let's do it here below, that instead of $87 that we paid for this trade, those $87 cents or $87 will be reduced by 33, making the cost of this trade to be $54. Okay? Making the cost of this trade to be $54. So if I do that, okay, and I uncheck the one above, right, and I check the one below, so what's happening to this trade now? Well, now the most you can lose is 54. Why? Because you pay 54. Okay. Now what's the most you can make? Well, the most you can make now is 67. So now the trade has improved. It's more than 1 to 1. Okay. And now the range goes from 85 to, let's say, 88.76. So it's about the same. It's more or less about the same. Okay. And let me see. Yeah. So that's more or less about the same. But notice something that I very much dislike of doing this roll. And basically, I'm just going to call for this trade. Very, very likely, I'm going to call for this trade to be closed. Okay. So take a look. If I use the prior or the current set of units that we have, which is April 23rd and April 9. So notice that, the gray line, let me zoom in. So the gray line and the blue line are more or less in the same place. Okay, so it's all good. Okay, but notice what happens if I use the next expiration date, which is April 16. So what happens now is that the gray line is clearly above the blue line. So in other words, time passing is hurting me now. Okay, I go from a theta, which should be fairly neutral, almost zero, which is actually positive 1.41, to a theta, which is now becoming negative, which is negative 0.75. Okay, and I don't really like that. Okay, I don't really like that. So again, if I was to see that volatility is in the process of rising, so then we'll stay with the trade. But if I was to see that volatility is still flat, and April 23 is still far away, and volatility is not looking like it's gonna rise, so and the VIX is going down, which is a big concern. So then we're just gonna call it the day, and we're gonna end up closing this trade ahead of time. And that's actually what's happening. Okay, so you can see we enter this trade here, and instead of getting to see something like that happen, right, which is what tends to happen before earnings, this thing went down and then it's kind of flat. Okay, so can it go higher? Yes. Is it likely going to go higher? Yes, but it's going to take more time, and that time is a time that we're going to have to suffer with a negative theta. I'm not happy about that. Okay, so what's happening here is that volatility should have started rising, but because the VIX has been going down, so it's kind of keeping the volatility of that particular stock, Philip Morris, is kind of like the volatility is being kept prisoner by the VIX, and we are not experimenting that increase of volatility as earnings are approaching. My last confirmation for this will be to look at the option chain and see. And yeah, well, I could see that volatility has increased when it comes to the expiration date that has to do with the earnings. Is higher than the current one or the one after. But notice how the one after, it's more or less the same value. So in other words, we are not seeing on that April 23 expiration date, we are not seeing any significant kick when it comes to the volatility rising. And hoping for that to happen with a negative theta is not making me happy any longer. And therefore, from a trade management point of view, my friends, I am now suggesting to close this trade. The trade didn't meet the expectation because we never got to enjoy the increase of volatility. You may recall that what the increase of volatility would do is this. Okay, let me be visual for a second. So if I go back to the trade we have, and I was to, take a look at the chart above, right, or the current P&L, which is $24. So if we were to enjoy, let's say, a 10% increase in volatility, next thing you know now, the P&L is 76. The maximum profit you're going to make now, it's 153. So again, everything gets majorly improved if volatility was to rise. But volatility did not rise because, again, VIX is keeping the IV of that stock prisoner. And the negative theta value that we would have by doing the roll this time, it's something that I would not see as convenient or acceptable. And therefore, we are just going to close this trade with Philip Morris and congratulate ourselves for a small profit made, nothing major, but definitely managing the trade, managing the risk, and adapting to the market conditions, based on the comments I have done. So I'm just going to go ahead and use a sell order. And I'm just going to go for the midpoint of the spread. Remember, there is no rush in closing this trade. You can take the whole day, okay? And whenever you get filled, then you get filled, okay? But that's it, I just got filled. So I'm out of this trade, okay? And, again, if I was to freeze the screen here, so, the net result of this trade is kind of $25 per contract. Again, nothing definitely magic. But taking into consideration that what we were hoping to happen, which is the rising volatility into earnings, did not happen at all. Actually, volatility went down, okay? And actually a pretty significant amount, if I'm not mistaken, because it went from 26 all the way to 21. So it's minus 5%, okay? So again, look at what happened if I type minus 5% here, okay? So next thing you know now, you will be minus $8, okay? So, if volatility has stayed the same, okay, instead of making $25. Okay, so I'm just gonna emulate that by typing 5. Okay, so you would have made $50, which is double the PNL. Again, not magic, because what we were expecting didn't happen. But I'm just playing with the values here, so you understand, why this trade worked the way it worked. And while again it was not super profitable, definitely we have done a good job here with the management, with the roles, and also hopefully from an educational point of view, you guys have learned a lot with this particular trade on the different things that we have been doing. Okay, so you guys let me know how is it. Mark, I see you just closed the trade. You got filled already. Thanks for reporting that. I love it. Thank you so much. So we are now going to continue with the other trades. Okay. Very nice. Thanks for that. Yeah, very good. Cool. Also looking at the time, it's probably a good time now to also disconnect from the public streams. For you guys that connected with us via YouTube, Facebook, and so on, thanks for joining me today. As always, I'll be back tomorrow, as you know. See you tomorrow, my friends. We'll keep going now with AFL, and then we'll get into looking at other opportunities in the market.